Hey everybody, morning, good afternoon, good evening, wherever you're at, what side of the earth you're on. Let us know in the comments so we can all say hi. So today we're going to do exchange traded funds and what's going on in that world. I'm studying this myself, so that's what we're going to talk about in this video. I'm going to try and do one of these every month so you can track if you're interested in that thing. I'm still trying to learn this myself, so we will be following along with the experts, which I am not. I am studying, okay, doing my homework. So all of my research and all this information you're getting today is from the experts, which is not me. I do some research and then I put it all together in this little video for you. And you can pick and choose what you want to use. But my references are Kiplinger's Money Magazine and Harvard Business Review. Those are normally the three that I pull my stuff in. I don't Google stuff because I don't know what is real and what is not. And you can do Google yourself. So if you want to do Google, that's cool. But anyway, let's look at that today. And you can see what's going on in the market. I'm going to go off the screen now. And low volatility funds payoff is what I'm getting from all the experts, which all of these things aim to offer a smoother ride or living up to their name. Since the start of the year, the U.S. stock funds strategies have dipped 7.7 on average, while the S&P 500 has lost 13.1, according to Legg Mason. Low volatility, high dividend ETF, which ETF stands for exchange traded funds for those who are beginner investors. The Legg Mason has held up better than both with a 2.2% loss. The fund is flourishing in an economic environment of higher inflation and rising interest rates. And this is July 2022. I'll try and put the month that we are in so that it makes sense on these videos. If somebody goes back and watches them 3 years from now, they're going to know, hey, wait a minute. They can go back and look at these and say, oh, wow, look where we were in 3 years ago. So it tracks an index that favors high-quality firms with an above-average dividend yield, steady, ample profits to sustain payouts, as well as low share price volatility. This is according to Michael LaBella, Senior Portfolio for Franklin Templeton Investment Solutions. Like I said, I'm not the expert, so we go and pull stuff from the experts. And this is where this is coming from. The portfolio tilts towards utilities, consumer staples, real estate, stocks, but no sector can make up more than 25% of the assets, and the fund sector preferences can shift. So Lockheed Martin, Coca-Cola, Johnson & Johnson are, of course, among the fund's biggest holders. All right, let's see where we're at. Here's some graphics for you if you are a graphic person, which I am also. So here's some of the graphics for that. Don't expect low volatility funds to outperform every market correction. These funds lagged the S&P in 2020, for instance. Legg Mason low volatility, high dividend struggle because it shuns firms that lack earnings and dividends. And the pandemic themed stock, which of course is like Zoom, that were rewarded last year, their exchange traded funds 10.2% annualized, 3-year return lagged. But over time, the fund was 5% less volatile. And it actually boosted a 3.0 dividend yield. So if you invested in Zoom, you would be doing pretty well right now. So how many stocks should you own? Well, with this year's rough ride, you don't need reminding that stocks are volatile. Their prices are bouncing up and down, sometimes in extreme ways. The U.S. market as a whole has produced average annual return of about 10% over the last century, but it doesn't go up 10% every year. In roughly 1 out of 4 years, it declines, and it declines sometimes a lot. All right, so let's go. Okay, we already read that. So let's go to how many stocks should you own? So if stocks return the same amount every year, then like bonds, they would yield gains of only a few percentage points. High returns on the rewards you get for enduring the fear, often the sheer terror of watching pieces of your nest egg disappear into thin air. People are like telling you to hold on, but enduring sickening declines is not easy, and that's pretty much where we are right now. Okay, let's go back and look at some of these graphics. These are select dividend-focused exchange-traded funds, which are going on right now, and this is current as of July 2022, according to the experts. The best way to smooth the ride is through diversification, and I'm not talking about portfolio diversification. I'm talking about the allocations of your assets to stocks, bonds, cash, and maybe more. Portfolio diversification is a necessity, but a subject for another day. The topic today is diversification in your portfolio that consists of stocks and stock funds. So if you need a certified financial planner, then let me know. I probably can hook you up with one that is an expert in diversifying your portfolio. The value of diversification seems obvious, but Morningstar data in June 2021, which let's see if we got this graphic up. It might be this one right here. There you go, right here. Right here is what we're talking about. Morningstar in 2021 showed that about 39% of all U.S. stocks have suffered 3 months loss of 50% or more, but a fewer 1% of diversified stocks incurred losses that were severe. And consider the sad tale of Enron, which once was a high-flying Houston energy company, collapsed in 2001, and thousands of investors, including employees who were invested in that stock, suffered huge losses. But Enron was also the 7th largest company in the Fortune 500, but in 2000, its market capitalization represented less than 1% of the value of the S&P index. So if you had put $10,000 in the S&P 500 index fund and all your other stocks maintained their prices, then Enron's trip to zero would have just cost you $100, which is reasonable. So Enron's earnings per share had climbed from 9 cents in 1989 to $1.47 in 2000, rising in nearly every year. But the company was cooking its books. So could the average investor have seen through this story and determined that the company was in trouble? No way. The smartest analysts missed out, and the only protection was to diversify, which was what I was trying to say. So how much is enough? How much diversification do you need? All right, so certainly owning an S&P 500 such as Fidelity 500 Index, which holds about 500 different companies and weighed by the market, will do the trick. Or for super diversification, there's Vanguard stock market, which an exchange-traded fund owns about 4,119 separate stocks. All right, so let's go back up here. I think this might be what we're talking about. So if you want to construct your own portfolio of individual stocks, a debate rages among economists on how many securities you need to benefit for diversification. It's a debate over how many adding extra stocks reduces your risk. In a 1968 journal article, 2 University of Washington researchers said that the minimum stock portfolio size should be 10. And another study conducted showed the standard deviation, popular measure of vitality, was 49.2, with a portfolio of just one stock of 23.9 with 10. But after that, the study found the risk declines to 20.2% with a 50 stock portfolio. For example, in 1987, finance professor Meir Statman disagreed, and in a paper he used different analytical methods to conclude that investors need no less than 30 stocks. All right, another group of economists led by Harvard's John Campbell determined that you need 50. I mean, in all these cases, the number of stocks is only a part of the diversification strategy. You need to diversify your sector too. If all the 30 of your stocks were in energy, for example, your annual return over the 10 years would have been a miserable 5.6%. So you need to keep your portfolios as close as equally weighted as you can. You're not diversified if you own 30 stocks, but if 29 of them are representing only 1% of your assets and one of them is representing 79%, the best way to stay balanced is to reallocate your holdings at the end of every year in 6 months. So you need to reevaluate every 6 months to a year and see and make sure you're diversified. Sell shares of stocks that have grown sharply in value and use the proceeds to buy more of the share. Be aware that by selling profitable shares, you will incur taxes. The deadly word, right? The nasty T word. So try to offset your losses or restrict your reallocating to a tax-deferred account, such as an IRA. And, of course, you will need to get with an accountant or a financial planner and set that up. If you need one, you let me know. All right, let's go back here to our mixed bag. So the way to solve the portfolio size conundrum is to own about 8 or 9 individual stocks, as well as diversified funds such as your Dow Jones, here it is right here, the SPDR Dow Jones, which holds about 30 stocks in the Dow, and the value of the assets in the stock, and fund portions that are roughly equal. Do you need international stocks or small company stocks as well as large caps to get true diversification? The experts say no. Certainly invest in European mid-cap stocks. For example, if you think such a sector is undervalued, but the objective is achieving market level returns, while suppressing risk, the best strategy is to stick with what you're comfortable in the U.S. large caps. Now, there is a downside to diversification. There is a downside to diversification. It has its costs. It dilutes strong conviction. And Andrew Carnegie, who in his day was the richest man in the world, disdained diversification. He said in 1885, the concerns which fail us now, which have scattered their capital, which means they have scattered their brains. Don't put all your eggs in one basket is all wrong, I tell you. Put all your eggs in one basket and then watch that basket. Now, Warren Buffett, the CEO of Berkshire Hathaway, agrees. He says that diversification makes little sense if you know what you're redoing. But his company at the end of 2021 held 40 listed stocks, but 41% of those assets were in a single stock. Apple and another 25% were represented by Bank of America, American Express, and Chevron. And I would say for anyone who really knows the business that have gone into 6 stocks is plenty, Buffett says, adding that the very few people have gotten rich on their 7th best idea. Now, I'm just throwing these ideas out here from the experts. You will have to make your own choice. You will have to study the market, as you probably already are if you're watching this video, and then determine where you might want to put it at. Most investors don't have the time or the inclination to really know those businesses. They are saving for a more comfortable life, retirement, and security, or their children, or not necessarily to strike it rich. Investors are happy or should be happy with an annual return of 10%, which would quadruple their investment in 15 years. In addition to owning broad index fund, you should get a strong diversification through low-cost managed funds, such as the Dodge. Let's see if we can find that on the Dodge and Cox stock, right up here at the top. For example, they have an expense ratio of 0.51% and annual return of 14%. Over the past 10 years. The fund has a 74 stock portfolio with a top 10 holding representing only 32% of the assets. Turnover is only 10%. The fund has held some stocks, including Wells Fargo and FedEx. Owning a single fund with great track record like Dodge and Cox or Fidelity Contra Fund, which has a larger portfolio, is top heavy. Or even Parnassus Core, which I've got right down here. It's like the 4th one. With only 40 stocks, but a broad combination of sectors, is really all you need to achieve diversification. So basically, July 2022, we are talking about making sure that your portfolio is diversified, even in this crazy market we're in right now, in this crazy economy. I'm getting ready to end this video, but I plan on doing an investment video for the rest of the year, once a week. Hopefully that's the plan, and we'll see what happens. As long as I got material to give y'all. I thank you all. Come on back and watch again.